Let's talk to Marc Ostwald. He is a strategist at ADMISI. Very good morning to you, Mark.
Good morning.
Right, we have four very thought-provoking chart slides. Let's, without further ado, kick off with the first one. The US versus the UK versus German, 10-year yields. What is this telling the crowd?
Well, I merely put this up because obviously one of the features of Q3 has been that for the bulk of Q3 we traded in a very narrow 21 basis point range on US 10-year yields and pretty much very narrow ranges on all the other major markets. This week, we've broken out of that range finally. We are up to 307, which in the greater scheme of things is not the end of the world. It just widens the range out to 27 basis points. But there are a lot of people talking about it.
Yep.
And they're asking themselves, so why suddenly, all of a sudden, given that we've still got all those trade concerns, the CPI data last week in the US was below expectations, though I would stress above target, but below expectations nevertheless. Why are we suddenly driving up US 10-year yields? And what impact is it having elsewhere? Well, I think the interesting thing is how it has dragged yields up elsewhere. So for as much as we are not expecting any immediate moves, either from the ECB, not before Q3 2019. The next Bank of England move, the market for the time being is discounting as next May. Though obviously political developments will be probably key to that, and we'll have to see how that pans out. That's very much a, stick your finger up in the wind and hope it. So you would think with US 10-year yields rising, raising the cost of corporate finance, we wouldn't be in this situation where coming into the end of this quarter, there's a good deal of optimism. Now, just to emphasize that point, if we move to the next chart, US 2-year yields are now up at 282.
Right.
The other ones, as you can see, have basically been doing nothing for a very long time. They are also supremely unattractive. When you look at the comparison, you've got a 200 basis point spread relative to the UK, and you've got a 335 basis point spread to Germany. So you would sort of think, well, why would anyone really want to be buying either UK gilts or German or Eurozone bonds, leaving aside Italy as a special category of its own? And that's a very good question. You would also ask yourself why, with these widening differentials, both in 2 and 10-year, why the dollar's come under some pressure this week. So I think it's an interesting situation that we find ourselves in as we go into the FOMC meeting next week, and also as we go into quarter end, because obviously quarter end generally implies a bit of rebalancing. So what about this FOMC meeting? Has the market taken on board in this rise in US 10-year yields some of the points which have been made? We know, for instance, if we look where that arrow is on there, that the market has been very much focused on, within the Fed's forecasts, and these are the June ones, on the longer run equilibrium rate for federal funds, which on that is 2.9, that's unchanged from March. They still, in June, and they didn't change this, even though they upped the forecast for 2019, still were emphasizing that in the short run, they still expect to raise rates to around 3.25, 3.5. That's what 3.4 means, 3.375. It's the midpoint of their projections.
Okay.
So I think the key next week is whether the Fed can convey this point to the market, because one of the reasons the market, I think, has been quite sanguine about Fed rate hikes and focus is that they've focused on what does the Fed think about inflation. And the answer is the Fed is very happy with inflation. You only have to look actually at its forecast to see that it's basically saying, look, we see headline PCE inflation around 2.1 and core. So around target, it's not a problem. And I think this is where the market's going wrong, because the market's actually been looking at this and saying, well, if it's around target, why do they need to keep on carrying rates? Well, the answer is actually rather more simple. Why do they need to keep rates down where they are when inflation is well behaved and not undershooting?
Yeah.
And when we start looking up that table to the more important point, which is the line above about the unemployment rate. Let's have a look at the longer run forecast. There is 4.5. That's what they think the natural rate of unemployment is in the United States. Their projections say that it's going to stay, well, it's going to actually fall. We've still got a little bit further to fall, to 3.6 this year and 3.5 in the next 2 years. So you're going to have a super, super tight labour market. And at some stage, the implications of that, with relatively robust growth forecasts, is it's going to spill over into wages. And that's why the Fed wants to carry on hiking rates towards that level. So the market's going to probably need to wake up to this. And it's going to be interesting to see how Mr. Powell sort of projects this to the market without sort of saying you've got everything mispriced, which is certainly not something that they want to do, but rather to emphasize, look, we are very determined to get to that 3 3/8 level, so you better think about how you've got all these risk price assets. So how have we got these risk price assets? Let's have a look at the next table. Well, as we know, yesterday we achieved new record highs on the S&P 500 and on the Dow Jones. And as much as there's been some pressure, and I'll apologize for the slightly messy chart here of the various credit spreads, but it's designed to make a point. In the credit arena, obviously the one feature of Q2 has been continued pressure on emerging market bond spreads. That's the foreign currency ones. But as one can see, as we've come into September, there's been suddenly a dash for trash. And if you look at the bottom of that chart, you've got the US high yield spread. That is close to its 2007 low. That's, we need to take this on board. The Fed's been raising interest rates. We've been worried about global trade. Yet high yield spreads, which are supposedly risky, are at their lows.
Right.
Investment grade spreads, I think that's interesting. Yes, they have widened out somewhat this year, but given, as one can see, that's the very right-hand scale on that chart, we've risen from about 80 at the low point this year to a high of 110, but we're back at 97. And that's despite the fact, and notably that last little move down is despite the fact that we've already done $124 billion worth of investment-grade corporate issuance, and we've still got another 6 trading days to go. It could be a record month, and yet spreads, are they actually saying, oh, well, we need to factor in a bit of an extra premium here to take down all this issuance? No. So we are in a little bit of a false world here. I think a lot of it still boils down to the fact that this is a financially repressed environment. People are still desperate for returns. As much as US Treasury yields have risen, they're not really rising to a sort of level where people can say, right, I'm going to go and park myself in 10-year or indeed in 2-year, and I still need to go and make a dash for risk as of when we get some widening in spreads, which I think really is above all what the EM's thing's telling us. Are we out of the worst for the EM area? I very much doubt it. I think we may obviously have a bit of rotation into it because it's underperformed during the quarter. But do any of those problems go away given the idea that the dollar will be supported by the fact that the Fed's going to carry on raising interest rates while everyone else is way behind them? So it is a very false world, and I think actually as we go into Q4, it's going to get somewhat trickier for investors as we go along. Next week, probably far more about people rearranging the deck chairs than anything else.
On that, Mark, thank you very much indeed.